and welcome to Business Standard. I'm Veenu Sandhu. Let's take a look at the stories for the day. India's economy is in focus today. India's goods exports fell by over 12% in April 2023, reflecting the slowing demand in the inflation-hit foreign countries. The industrial output grew just a tad above 1% in March, which was the slowest in 5 months. Inflation numbers meanwhile offered some breather. So what do these three critical parameters of India's macroeconomic growth tell us about the country's growth story? Debaryo Sanyal goes behind the numbers to bring you the larger picture.
Various wings of the Indian government recently released a set of telling numbers on three of the nation's most crucial macroeconomic markers: inflation, industrial production, and trade. While all three numbers saw a dip, the implications of the drop are quite different for the different markers. Let's begin with the good news. India's retail inflation rate in April fell to an 18-month low on the back of a high base and easing price pressures across categories. Data released by the National Statistical Office or NSO on Friday showed that the CPI-based inflation stood at 4.7% in April, as against 5.7% the previous month. Due to moderation in the food, fuel, clothing and services prices, the headline inflation rate stayed within the Reserve Bank of India's upper tolerance limit for the second consecutive month in 2023. The RBI has an inflation target of 4% with a margin of 2 percentage points on either side. The Wholesale Price Index or WPI, which measures change in the overall price of goods before they are sold to people like us, also fell. But it went into the negative territory in the latest data. This is deflation. It fell to a near 3-year low of negative 0.92% in April. It is for the first time that WPI has slipped into negative territory in 33 months. The reason? A higher base effect and continuing contraction in prices of manufactured products. Data released by the Commerce and Industry Ministry on Monday showed prices for manufactured items contracted further, led by a decelerated price rise in items such as beverages, tobacco, apparel, leather, pharmaceuticals, and cement. Meanwhile, the growth in factory outputs measured by the Index of Industrial Production or IIP fell to 1.1% in March from 5.8% in February. This was largely due to a decline in output growth in manufacturing at 0.5% and a contraction in electricity output at negative 1.6%. Consumer goods, particularly durables, were amongst the worst performers in 2022-2023, though the output index of consumer durables was up just 0.5% in 2022 to 2023 compared to 3.2% in the previous year. It contracted almost 4% compared to the pre-COVID year of 2019-2020. This can be attributed to muted demand due to high inflation and loss of income during the COVID times. The recent deceleration in inflation may have a lag effect if the trend continues. However, the most troubling dip was visible in India's trade numbers. In April, exports fell to a 6-month low and imports did their worst in 20 months, both in value terms, as sluggish demand for Indian goods due to an economic downturn in key destinations and easing commodity prices weighed on India's trade basket. The data released by the Commerce Department showed outbound shipments from India witnessed a sharp 13% contraction at $35 billion during the first month of the fiscal year, while those inbound saw a sharper decline at 14% to $50 billion, leading to a 20-month low trade deficit at $15 billion. This is the third consecutive month of contraction in exports and the fourth for imports. Are we then witnessing the first shades of trouble in India's macroeconomic portrait?
Yes and no. Now, as far as the WPI is concerned, so it's a combination of a decline in the global commodity prices and the very high base effect that we had last year. Now, as far as the CPI is concerned, so the CPI has started to weaken, but if you look at it, not as fast as the WPI has gone down. So on the inflation numbers, nothing much to worry about. As far as IIP is concerned, IIP is very weak. It continues to be weak, which means that industrial recovery really hasn't started happening yet. This becomes more worrying when you look not just at the export numbers, you look at the export numbers and the import numbers. The export, of course, is a sign of global weakness. As far as imports are concerned, that's also showing weakness because there is a decline, absolute decline in the volume of imports as well. That's not good news.
And what could be the potential challenges and opportunities moving forward?
I don't think these are disturbing signs. I think the only problem area is exports. I think the opportunity still exists in promoting services exports. I think where the global capability centers, etc., are leading them. So we should focus on cashing on this opportunity in the near term. And second, I think the opportunity also comes from diversification of supply chains, some of which are moving towards India, not all of them. Now, the worrying part is the goods exports. The growth rotation away from US and Europe towards China doesn't help us. So I think the sectors which are labor intensive will require some support, I think, in this environment.
Experts therefore point out that the global environment is still fragile, but the interest rate hike cycle is also coming to an end in most parts of the world. So, inflation is likely to soften in the rest of the world too. But interest rates remain very high, and India should be wary of the spillover effects of risks that such high interest rates entail. They also believe that we must step up our domestic demand with a specific focus on incentivizing personal consumption.
The world economy went into a tailspin when the pandemic struck, and countries are still paying the price of it. But the World Health Organization recently said that COVID-19 is no longer a global health emergency. Shohini Das caught up with prominent epidemiologist K Srinath Reddy to find out where we stand now and what the road ahead looks like. Let's listen in.
Good morning, Dr. Reddy. Thanks for taking out time for the Business Standard Show.
Good morning. Happy to be here.
So my first question to you would be that, was it the right time to declare the end of the pandemic, or is it too late or too early? What is your opinion?
Well, I think it could have been done a little earlier, but I believe given the fact that in some parts of the world, still there were a very large number of cases, and including a fairly high number of daily deaths, and the fact that in China, after the sudden opening up, there were reported large number of cases, and there were predictions through incorrect models, as it appears, of anticipated high number of deaths in China. I think the World Health Organization decided to be a little more cautious and wait for time and study the trends. And I think while it might have been slightly delayed, it has come, I think, to a right conclusion that the pandemic must be declared, not as having ended, but having ceased to be a global public health emergency.
Right. And what kind of investments you think need to continue for COVID-19 in India as well as globally?
Well, as I said, we need to build a very strong health system, strengthen urban and rural primary health care, then also ensure that you build up an adequate health workforce in numbers, skills, and distribution. Now, if you do not have enough primary healthcare workers, frontline health workers, if you do not have enough lab technicians for doing the lab tests, if you do not have enough critical care personnel for administering critical care in whichever setting, whether it's a district hospital or a medical college hospital, then we are going to be caught short-handed. And remember, not only we have shortages of health workers, there are also human beings who are likely to get infected. Some of them will die. Some of them will become ill and incapable of performing their duties. And even if they're young, the moment they're infected and diagnosed to be infected, they're asked to isolate themselves. So either because of illness or because of exhaustion, they're unlikely to be always available in full numbers. So you need to have what I call a slack capacity, an expansile capacity, which can call upon those additional reserves, whether it's nurses or doctors or frontline health workers. So a strong health workforce and primary healthcare systems are absolutely important, along with emergency transport systems. And of course, now telehealth and telemedicine have been built, and digital health has been deployed fairly well after the initial stages of the pandemic. All of those resources, we need to continue to develop and invest in them as we move along.
We use vaccines for other infectious diseases as an annual dosage for children. Is it about time that we think of having an annual vaccination program for COVID-19 for adults?
Well, right now the evidence is not very convincing, or we need more evidence for that. Firstly, children themselves are not at very high risk. The people at high risk are people who are elderly, whose immunity has been weak, and even if vaccinated, it might wane very fast, faster than of younger individuals. People who are immunocompromised, immunodeficient, or on chemotherapy, they're at much greater risk. People who have severe comorbidities are likely to be affected also much more. And therefore, these are the people who ought to be really protected. And in them, again, while it is advisable that we boost their immunity by giving them boosters, whether it should be annual or not needs to be seen, the rest of the population at the moment does not appear to be in need of a booster dose. Secondly, we must also be a little cautious about excessive use of booster doses, because if these are repeatedly challenging the body's immune system to react to that particular antigen, then it's always fighting the same battle. It is, firstly, there is something called T cell exhaustion. The T cells, which are very important components of the immune system, may get exhausted by fighting these battles repeatedly. And the body's immune system may not have the capacity to react to a new variant because they're still identifying the vaccine-related antigen as the only enemy. If a new variant comes in, then it may not be able to react to that. Or against other microbes as well. If you're already exhausted, most of your resources are exhausted in fighting the antigen that is being provided by the vaccine, your body may not have the capacity. So you have to do that risk-benefit analysis and say, okay, which is the group that is most likely at high risk and who is likely to get high benefit, and which are the other groups where the benefits are low and the potential risk of excessive booster doses may be high. So I think we have to be judicious in our choice of whether we are advocating boosters, when and to whom.
Thank you so much, sir.
While every aspect of our lives was impacted by the pandemic, Indian markets somehow remained immune to the virus. Over the years, the Nifty IT index has closely mirrored the moves of the NASDAQ index. So far, calendar year 2023 has, however, proved to be different, with both these indices performing differently. So, is the correlation between the two indices ending? Here's Puneet Wadhwa's report.
The tech-heavy NASDAQ in the US and India's Nifty IT index have shown a strong correlation with each other over the past few years. The correlation, however, seems to have snapped this year. Thus far in calendar year 2023, the tech-heavy NASDAQ has rallied over 18% and has outrun peers such as the Dow Jones Industrial Average and the S&P 500. On the other hand, the Nifty IT index has lost over 2% in CY23. So, does that mean the correlation between the NASDAQ and the Nifty IT index has ended? Ajit Mishra, Vice President of Technical Research at Religare Broking, does think so, at least for now. As an investment strategy, he suggests investors remain stock selective.
So it's almost a year now that we are seeing the IT index, trading under pressure post the breakdown from the distribution pattern. It made a base around 26,000 mark and attempted a couple of times for a reversal also in the later of 2022. But the selling pressure in the March 2023 again, result in retesting of those monthly support zones. And now it's currently, trading subdued. And the important aspect is that earlier we were seeing the rebound and recovery in line with the US tech-heavy index, that is NASDAQ composite. But that correlation is not working as of now. So we feel that from the short to medium term perspective, the first hurdle is going to be 29,000 mark. And for any reversal, sustained reversal, 31,600 is the key resistance area.
At the fundamental level, analysts expect the weakness in IT stocks to continue as fears of recession may keep a lid on IT spending by companies in India and abroad. According to G. Chokkalingam of Economics Research and Advisory, the remaining part of CY23 will be painful for Indian IT companies in the backdrop of recession fears as BFSI companies, which contribute 32 to 33% of IT firms' revenues, cut costs. Thus, while it may be too soon to establish whether the correlation between NASDAQ and Nifty IT have ended for good, the near-term outlook for Indian IT companies remains uncertain. On May 19, stock-specific moves will dictate the market trend.
If you are someone who uses credit cards for international transactions, we have news for you. From July 1st, your credit card transactions abroad will get costlier. Not only will you have to pay a 20% TCS on each of these transactions, but you will also have to limit the spending to under $250,000 in a financial year. Raghav Agarwal breaks it down for you.
The Centre has amended the Foreign Exchange Management Act of FEMA rules, bringing international transactions made through credit cards under the Liberalised Remittance Scheme or LRS. With this, international spending using credit cards will attract a 20% TCS or tax collected at source. The Liberalised Remittance Scheme was introduced in 2004 by the RBI that allows resident Indians to freely transfer up to $250,000 per financial year abroad. This is also applicable to transfers by minors. For amounts above $250,000, the individual needs to take prior approval from the RBI. From July 1st, the payments made through credit cards abroad will be counted under the LRS limit. It will also be applicable on internet purchases abroad via credit cards, even if you place the order from India. This includes in-dollar subscriptions to foreign magazines and journals too. These transactions will attract a TCS of 20%. This tax rate was increased from 5% previously to 20% in Union Budget 2023-24. The mechanism of how TCS on overseas credit card spending will be collected is not known as of now. If you spend $100 on buying something abroad using your credit card, you will need to fork out $120 now, with $20 going to the government as tax collected at source or TCS. However, taxpayers will be able to claim refunds of the TCS paid while filing their tax returns. This additional $20 paid as TCS will be adjusted against your tax liability. Till now, transactions made abroad via credit cards were not a part of the LRS limit. They were not counted in the $250,000 limit. They did not attract an additional TCS. But now, customers must track every bill and be mindful of the spending limit on the next foreign trip. The LRS limit, however, does not apply to remittances for education or medical treatment. If the transactions are made through international credit cards on online platforms based in a foreign country, they will attract a 20% TCS. For example, purchases made on Amazon.com will be subjected to a 20% TCS, but not those bought through Amazon.in.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
With the new rules for international transactions now, you will need better financial planning. Well, that's all for today. For more news and analysis, please log into our website business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.